Hello, everyone. Thanks for the warm introduction. Mr. President and executives of CFA Society Ghana, colleague CFA charter holders, distinguished guests, all protocols observed. I'm humbled to have been invited by the leadership of CFA Society Ghana to present at the maiden CFA Forecasting dinner. The first question that ran through my mind after I accepted the invitation was, Jojo, what have you gotten yourself into? And what exactly are you going to say? You would all agree with me that forecasting is very much an art based on a series of assumptions and not an exact science. Clearly, if one knows what would happen in the future, one can take an appropriate trading position to maximize profitability and go on early retirement. This presentation is based on personal thoughts on economic outlook and do not represent the views of my employer. I have to put that caveat out there. The forecasts are based on a series of assumptions that are detailed in the presentation. The assumptions are open to interpretation, and hence I would appreciate during the panel discussion any comments on opinions that you may have on the assumptions. The forecasts are done from an apolitical perspective, considering the environment within which we are in. Hence, I would appreciate anyone sharing content, whether on social media or traditional media, to state the facts and the context within which the presentation is made so that we avoid any form of misrepresentation. Unfortunately, sometimes the media can be whatever. So, the impact of COVID-19 pandemic continues to be a challenge to the global economic recovery. The world is now learning how to live with the COVID-19 virus and the numerous strains and mutations that we continue to get. As evidence, the UK has already lifted all its COVID-19 protocols in England, and of course that is an experiment that we'll all wait to see over the next 2 to 3 months how that pans out for them. Vaccines have enabled economies to reopen after the COVID-19 pandemic hit 2 years ago. However, the constantly mutating virus has made the recovery quite intermittent. As seen in the chart, vaccine access in emerging markets continues to lag that of developed markets significantly. And hence, the recovery that we are seeing globally is more led by the developed markets than the emerging markets. This data, as at yesterday, shows that vaccination within Africa for single shot vaccination is at 16%, whereas the world average is at 61%, and the European Union average is at 74%. Highlighting a few African countries, Botswana has 50%, which is great. Egypt, 32%. South Africa, 32%. Angola, 27%. Ghana, 22% of the population taking the very first shot of COVID-19 vaccines. Cote d'Ivoire, 19%, and Nigeria, 6.5%, which is woefully inadequate. Now, if you compare this to developed markets such as Germany with 75% vaccinated, US with 76, UK with 77, Japan 80, China 88, Singapore 90, and UAE at 99%. Sectors such as aviation, hospitality, and tourism will remain challenged globally as long as these travel restrictions remain. And there are, of course, mandatory quarantine periods in specific countries. Now, when the COVID-19 pandemic hit, the G3, hello, sorry, can I get help with the clicker? Next slide, please, if you can help me. Yes, thank you. So when the COVID pandemic hit, the G3 central banks, being the Federal Reserve, the European Central Bank, and the Bank of Japan, delivered extraordinary monetary accommodation via asset purchase programs to counter the impact of the COVID-19 pandemic. These actions resulted in interest rates falling to record low levels. And now that we've gone through 2 years of the pandemic, the central banks are expected to taper their asset purchase programs and unwind the accommodative monetary policy that they've had over the last 2 years. This is evident in the left chart, showing the G3 central banks' balance sheet expansion at the start of the pandemic and the subsequent unwind forecasted by end of this year. The asset purchase program benefited emerging markets with investor flows, and hence the hint of tapering has seen emerging market yields tumble. The US 5-year swap rate, which is representative of where you would get 5-year funding from the US at, dropped from 1.72% on the 1st of January 2020 to a record low of 0.24% in August 2020. However, it's recovered back to 1.75% as at this morning, which is back to the pre-COVID level. In essence, the days of cheap money are coming to an end, and market expects many central banks to start hiking rates. Inflation has many central banks concerned, and markets have started pricing rate hike expectations in most countries. In the US, inflation hits a high, 40-year high of 7%. And sets the tone for the first rate hike by the Federal Open Market Committee in March and a second in June. Highlights from the press conference held yesterday by Jerome Powell, the Fed chair, included statements such as this: quite a bit of room, and I'm quoting him, quite a bit of room to raise rates without hurting jobs. The Fed may move sooner, faster on balance sheet than last time, which was the last time they had to end tapering. FOMC is of mind to raise rates at March meeting, which is basically informing the market that a decision is made that they're going to hike rates in March. And the supply side relief is taking longer, raising inflation risk. Clearly, inflation is still very much on their mind at this point in time. Following his comments, the market increased pricing by about 30 basis points for the March FOMC meeting, which means that 25 basis points is fully priced in, and there's about a 20% probability of a 50 basis points hike in March has been priced into the market. The market has also priced approximately 150 basis points hike over the next 2 years, moving the Fed fund rate from 0.25% to 1.75%. Other central banks, such as the Bank of England, the ECB, are also expected to hike rates as well. Can we move to the next slide, please? The fast-spreading Omicron variant is bad news for the global economic recovery. Okay, threatening supply chains, disruptions, and obviously we have seen the impact on the computer chip industry as well, where at a point in time they only had 5 days of supply within that industry. Freight charges for shipping containers remain elevated. The chart on the left shows that the cost of a 40-footer container moving from Shanghai to Los Angeles is 6 times higher than the cost pre-COVID. And that industry clearly would continue to have an impact until the world gets to the point where COVID becomes a norm. China is one economy where monetary tightening is not expected. Rather, markets expect both fiscal and monetary policy to support growth. There are lingering weaknesses within China. The property sector, where you have the Evergrande crisis, and other property developers missing payments on the bonds that are due to investors. China's growth is moderating, due to macro and regulatory policy tightening and a stringent COVID strategy. COVID outbreaks in China have resulted in some cities being placed under lockdown, negatively impacting economic growth prospects within the China market. SCB Research expects the renminbi to further strengthen in the near term, supported by fundamentals including a record trade surplus, capital inflows, and a hefty interest rate premium over the G10 currencies. Interest rates in China are around 6%, whereas interest rates within the G3 countries are still sub 1%. Looking at GDP projections, IMF this week came out with a global outlook. They revised their initial outlook in October last year down, which was 4.9%, down to 4.4%, the same level as SCB Research, based on their expectations that global growth will moderate this year considering the impact of COVID. IMF projects growth in US, China, and Sub-Saharan Africa to be around 4%, 4.8%, and 3.7% respectively. And SCB Research projects these to be around 3.5, 5.3, and 3.1. For China, SCB Research is much higher because the view is that China's policies will continue to be pro-growth, and that would support their economy. Moving to the next slide. The image of a man walking a tightrope aptly describes Ghana's economic outlook in the near term. Essentially, the government must carefully balance its actions on revenue mobilization, expenditure rationalization, borrowing strategy, and debt service over the medium term to ensure it successfully navigates what can best be described as a challenging economic environment. In forecasting the budget, it is important to analyze the original budget, not the revised budget, versus the actual outturns that have been achieved by government over the past 5 years. So let's start with revenue. If we can move on to the next slide, please. In 2017, the total revenue and grants outturn was 41.5 billion, which was 7.7% lower than the original budget of 44.9 billion. And the shortfalls were largely due to international trade, which was 22% down, non-tax revenue, which was 20% down, and tax revenue, which was 10% down. In 2018, total revenue and grants was 47.6, 3.6% lower than the budget of 49.4 billion. And the shortfall again was due to non-tax revenue, which was down by 18.9%, tax on domestic goods, which was down by 11%, international trade taxes, which was down by 9%, and other revenues, which was down by 13%. In 2019, total revenue and grants was 53.3 billion, 9.4% lower than budget. And again, shortfalls were largely due to non-tax revenue, which was 20.9% down, international trade, which was 27% down, taxes on goods and services, which was lower by 6%, and other revenues, which was down by 23%. 2020, we saw the impact of, and hence revenue was down by 17.8% at 55 billion cedi. Again, tax revenue was down by 9.7%, and non-tax revenue was down by 49%. 2021, total revenue and grants was 70 billion, 3% below budget, and shortfalls were due to 37% drop in non-tax revenue and a 5% drop in tax revenue. The other revenue segment exceeded budget by 40%. The compounded annual growth rate of revenues, total revenues between 2017 and 2021 was 14%. Year-on-year growths was 14% in 2018, 12% in 2019, 3% in 2020 due to COVID, and 27% in 2021. Government is projecting 43% year-on-year growth for 2022 in total revenues and grants, bolstered by new revenue measures introduced in the budget, such as the e-levy, which accounts for approximately 40% of the new revenue measures, restoration of benchmark values of imports, and enhanced tax measures. In forecasting the 2022 budget, a few adjustments have been made to government's estimates, and I'll take you through the assumptions. Tax revenue has been adjusted lower by 10%, okay, from 80 billion to 71 billion, based on below factors. Government has projected a 31% increase in company taxes this year, but that has been revised lower to 20% year-on-year increase, which is in line with what was achieved in 2021. And if you look at the compounded annual growth rate for company taxes from 2017 to 2021 was 24%. However, government have announced an expenditure-led consolidation this year, so we think the private sector would be impacted by the fact that government will not be spending as much as they spent in previous years. Other taxes have been, government had projected other direct taxes at 40%, and